Hello, fellow options traders and investors. Welcome to my channel. This video is part of a series of videos depicting the step-by-step process on how you can trade various option strategies on the Interactive Brokers IBKR Mobile App. This video will focus on walking you through to set up a covered call trade. Just a reminder, I am not a financial advisor, so everything that I share in this channel is not financial advice. My content is purely for educational and entertainment purposes. Okay then, let's start today's video, shall we? Selling covered calls for income is an option strategy to generate additional income from shares that we already owned. This may be used on stocks that do not pay or pay very little dividends, such as growth stocks like Tesla. On the IBKR mobile app, the first step would be to select the Portfolio tab on the bottom of the page. Then look for your selected stock under the Instrument field to check how many shares you currently have. Under the Position field, take note of your average price, as that should be considered when you select your strike price when selling the covered call. As shown, I currently have 600 shares of Tesla at an average price of about $243. I am pure options trader who does not buy and hold shares for long term. These shares were assigned to me previous via options. I've collected premiums from them since about 1.5 years ago, so my actual cost is much lower than $243. This forms my base consideration when I am selling covered calls on them. Enter the Tesla options chain page by tapping the Tesla symbol Tesla, as shown. Construct your covered call in this options chain page. Start by selecting your preferred days to expiry DTE. For me, I prefer weekly DTE for selling covered calls on volatile stocks like Tesla and Nvidia, for example. Selection of strike price is next. Some consideration includes your cost price of the shares. At what price are you comfortable to let them get called away? And also the premium available for such strikes. I usually use delta and basic technical analysis to assist in my selection as well. For this trade, I selected the strike price of $315 at a delta of around 15, which can also be inferred as there's about 15% probability of this trade being in the money at expiration, aka my shares will be called away at $315. After selecting the strike price, tap this location under Bid, as shown at Step 6. Then tap the Order button. Do ensure that it is showing credit to confirm that we will be receiving premium. I quickly took a look at the weekly chart for Tesla on TradingView. Fibonacci level of 0.5 is about $314. This may provide some resistance to my strike of $315. In any case, if Tesla did manage to rally past $315, I could decide to roll this trade upward in strike price and outward in terms of DTE. This rolling strategy may increase the overall amount of premium collected, as well as increase the potential for higher capital appreciation on these shares. I will discuss on this rolling strategy in another video. Going through the IBKR platform, selecting quality of one means one contract, referring to 100 shares of U.S. stocks, such as Tesla. For order type, I always use limit order. This is to fix the exact amount of premium receivable. For the limit price, as this is a single order trade, this selling order means it is a credit trade. For this case, we will be collecting a premium of $225, excluding any transaction fees. For time and force, I will choose good till cancel. I will only choose day trade if I do not wish to enter this trade, if it does not fill after today. Finally, hold and slide the buy button to submit your order. Order submitted. We have successfully submitted selling a covered call order on the IBKR mobile app. As a bonus to this IBKR covered call video, I'll share some pros and cons of this covered call strategy. For pros, this strategy may generate income from non-paying or paying very low dividend stocks. Secondly, selling covered calls on existing shares can reduce the cost price of these shares, hence reducing risk of these holdings. On the cons, for stocks that are for long-term holding purpose, do note that your shares may be called sold away, meaning you may lose those shares you may want to keep for long-term value appreciation. And if the stock price rose above your covered call strike price, you may lose the upside gain. If the stock price stay elevated for a long period of time, your average cost may increase if you buy them back at a higher price than your initial price. If you feel I am providing value, please help me to click like, share, and subscribe. I wish everyone here is having a wonderful day. Please stay safe and manage your risk. Thank you for watching, and stay tuned to the next video.